This lesson is titled Taking Control of Your Finances. In this lesson, we're going to go over monthly net cash flow and discuss some items related to budgeting, and we're also going to calculate monthly interest rates on a loan based on an annual interest rate given. So first, cash flow. So a couple of terms to know. Your monthly income is how much you earn or make in 1 month. Examples of income include paychecks, scholarship money, even gifts, monetary gifts that come in during the month would all be considered income. Monthly expenses are how much you spend or what you're designating to save in a month. So some examples of spending might be food, cell phone, school supplies, tuition. And then I also mentioned what you're designating, so what you're putting away to save, which will relate to one of the next problems that we do. But those are also considered expenses because you're putting it somewhere, even though it may not be going to like a company. Okay, so when we talk about monthly net cash flow is your income minus your expenses. Now, if you have a positive net cash flow, that means that your income was more than expenses, which is where you want to be. If your cash flow is negative, that means your expenses were more than your income, or that you spent more than you made. So an example of cash flow, the expenses and income of someone are given below. Find the monthly net cash flow, assume wages and salaries are after taxes, and then also assume that 1 month is equal to 4 weeks. Okay, so I'm going to make this a little bit bigger. So notice how this problem is talking about monthly net cash flow. So when we're talking about monthly net cash flow, we need to make sure that all of our items are in the units of month is a way to think about it, or that everything is talking about month. Because if you add a yearly amount to a monthly amount, what does that mean? Okay, so we'll start with income, $1,000 per month. This one's good. $2,400 per year. If we're going to estimate that as a monthly amount, we would divide by 12 to get 200. So for this individual, their income is 1,000 plus 200, which is 1,200. Okay. So let's go over to expenses. I'm actually going to start with food. It's a little bit more straightforward. $50 per week, and if we're assuming that there's 4 weeks in a month, this is 50 each week, or 50 times 4. So this would be 200. $40 every 2 weeks. Well, if you get 40 every 2 weeks, how much would you get in 4? You would multiply this times 2 to get 80. $30 per month for incidentals, which really just means miscellaneous. Cell phone bill, 80 per month. And let's talk about the tuition, $5,400 twice per year, or another word you might see is semi-annually. So if we're talking about twice per year, there's a couple different ways that you can think about this. $5,400 twice per year is talking about 6 months each. So you could take 54 and divide by 6. Or since it's twice per year, you could take 5,400 times 2 and then divide by 12. You'll get the same result either way. Do it the way that makes sense to you with the terminology that's being used. So that would be $900 a month in tuition. So let's add up the expenses. It would be 900 plus 80 plus 200 plus 80 plus 30, and let me plug it into my calculator, which would give us $1,290. So when we're looking at our cash flow here, it's income. It's always income minus expenses. How much you made minus how much you spent, which would be 1,200 minus. So this person has a negative monthly cash flow, which is okay. All that means is that their expenses were more than what they made. Well, it's not necessarily okay because maybe they shouldn't be making those financial choices, but cash flow can be negative, and that's why. Budgeting. So I'm going to talk a little bit about what you'll see in the homework, as well as just some budgeting, just maybe some practical things that you might find helpful. So one thing that to consider in a budget that could be labeled as an expense or is labeled as an expense, or any savings goals, are what I like to call buckets. So for instance, and we'll do this in the next problem, rather than paying my car insurance all at once and getting hit with a big bill that I wasn't expecting, I divide what I estimate it to be by 12. So each month I'm saving just a little bit at a time. And I call those my buckets. Same thing for Amazon Prime. I just save a little bit each month so that by the time the renewal comes up, I have it, it's ready to go. I don't get surprised by a bill. Okay, that's just me personally. It's not something you have to do. But in the next problem, you'll see how that might be practical. Okay. We'll also understand your spending as it relates to other categories. So understanding like what percentage of expenses compared to one another. And then there will be some charts where you'll be able to compare what someone spent to the national averages to maybe make decisions. Okay. So first thing, your car registration is due next year. You estimate your registration will be $220. How much should you set aside each month? Well, if you don't want to be surprised by a bill, it would be 220 divided by 12, which would give us $18.33 per month. Okay. If you were to list this, and you're not being asked to do this, but I'm going to reiterate that even savings goals and these buckets count as expenses because that's money that you're setting aside. Okay. Example 2, compute the total cost per year of the following pair of expenses. Then complete the sentence. The first set of expenses is what percent of the second set of expenses? Maria spends $5.25 a week on coffee and $125 per month on food. In the problem, it's asking us to explain the cost per year. So again, we need to make sure our units match. We have a weekly amount and a monthly amount. So before we do the percentages, we have to get this to the same thing. And the problem is telling us to make sure that it's in cost per year. So $5.25 a week, we would multiply by 52 because there are 52 weeks in a year. This would be 273. Okay, and then 125 per month on food, we would multiply that by 12, which would give us 1,500. So the problem is asking us, complete the sentence. The first set of expenses is what percent of the second set of expenses. So we're talking about that fraction or ratio language again. So what we would do is we would take the first set of expenses divided by the second set of expenses and then multiply by 100%. This would be 18.2% of the money spent on food. Okay, so just kind of as a visual, let's say we were spending $1,500 on food. This is halfway, that's about a quarter. Visually, you're spending about this much on coffee compared to how much is being spent on food. So that's what that is telling us. Example 3. So the rule of thumb is to spend no more than 30% of monthly gross income on housing, which means rent or what you might hear as PITI, which is principal, interest, tax, and insurance, or mortgage payments. Okay. An individual whose gross monthly income is $3,200 spends $1,300 on housing. Are they living by this rule of thumb? So you may see problems similar in the homework, but this is an actual rule of thumb that you can look at. It varies. Sometimes the percentage is lower if it's talking about net income. Gross income is how much you make before they start taking out all of the taxes. Your net income is what's actually deposited in your home. So you may see different percentages. Typically, you'll see between 25 and 30%. But let's see if this person is living by that rule of thumb. You could think of this as a part percent whole problem, or you can say we're trying to find out what percent is 1,300 of 3,200, which means that we would divide and multiply by 100%. And so I'm getting 40.625%. So no, this person is not living by that rule of thumb. Okay. If you go to like rent a place on your own, sometimes they'll say that you have to make like 3 times as much as the rent, and they're kind of going by this rule of thumb as well. Okay. Example 4. So this figure kind of summarizes different averages of what people are spending by category. I'm going to zoom in. The purple is dealing with people under 35, the blue is dealing with people 35 to 64, and the beige is 65 and older. And then there's different categories of spending by age group. So we'll do this problem and then we'll come back to this chart. Okay. So it'll zoom back out. A family with a 45-year-old wage earner has an annual household income of $46,000 and spends $1,500 per month on housing. We want to know if this person who's 45 is spending within the averages. Okay. So what we would have to do is $1,500 is per month and $4,600 is per year. It doesn't matter if you convert the monthly amount into an annual amount or the annual amount in a monthly amount. the percentage will come out the same. Okay, so I'm going to take 1,500 times 12, which is 18,000. And then to determine what percentage this person is spending on housing, we would take 1,800 or 18,000 divided by 46,000. And this comes out to be about 39.13%. Okay, so going back to our chart, housing for someone 35 to 46 should be about 32.1%. This person is spending 39.13%. So this person is spending above. Okay. So in the next lesson, we'll talk about. So in this part, we're going to talk about monthly interest payments. In the next lesson, I think it's 4B, we'll take a deeper dive into interest. But for now, we'll give our interest in annual percentages. You'll divide by 12 to determine what that would be monthly, and then you'll apply part percent whole in order to calculate monthly interest payments. So the first example is you maintain an average balance of $120 on your credit card, which carries 24% annual interest. Calculate your monthly interest amount. Okay, so this interest rate is annual, and so what we have to do is divide that by 12 in order to get the monthly interest rate amount. Whenever you're working with rates like this, you typically want to convert them to decimals. Okay? So in this case, this is equal to 0.02. And then you can apply part percent whole if you want, where 120 is the whole, you have your percent as a decimal, and the interest payment would be the part. So you can set up the triangle like we did in previous lessons, or you might see that you could take 120 times 0.02. Which would give 2.4. So this monthly interest payment based on the scenario is $2.04. Next, Vic bought a new TV for the big game, can't say Super Bowl, for $1,800. Vic makes a down payment of $700 and finances the remaining balance through the store. Unfortunately, Vic was unable to make his first payment and now pays 3% interest per month. What is Vic's monthly interest payment? So in this problem, be careful. The original price is $1,800, but Vic put $700 towards that amount. So that's what a down payment is it's going towards the base price. So the amount on the loan, or the amount that's being financed or borrowed, is $1,800 minus $700. So we're talking about $1,100 here when we're talking about interest. You only pay interest on the balance. So if you, whether it's a house or some kind of product or a car, if you put money down, you're not borrowing that money. So that's why you subtract it out in order to calculate the interest payment. Okay. And then 3% interest per month. So we would take 1,100 times 0.03, working with that rate as a decimal, which would be an interest payment of $33 per month. Thank you for watching. If you have any additional questions, please feel free to reach out to me.